Okay, so you want to run the British economy. Fine. Here are the keys. You've just taken charge of roughly $4 trillion of annual output, 69 million people, the world's second largest exporter of financial services, and a government that owes about 2.9 trillion pounds to people who expect to be paid on time. Before you sign anything, look at one number. The Institute for Fiscal Studies ran a simple thought experiment. They asked what Britain would be producing today if, after 2008, it had grown at the same pace as the United States. Not faster, the same. The answer came back at around 41,000 pounds of output per person. What Britain actually produced was about 37,000, 4,000 pounds per person every single year, missing. That is not a recession. Recessions end. That is a gap that opened in 2008 and then simply stayed open while 3 prime ministers walked past it. And here's the part that should genuinely unsettle you. In the 35 years before 2008, British productivity doubled. In the 15 years after, it rose by about 5%. Almost nobody puts those two figures side by side, because when you do, most of the arguments you hear on television stop making sense. The tax argument, the immigration argument, the spending argument, all of them are downstream of that one broken line on a chart. So let's not argue. Let's open the books. By the end of this video, you will be able to look at any British headline, a budget, a factory closure, a strike, a bond market wobble, and know exactly which part of the machine is making the noise. Not an opinion, a working diagram. If you like economics explained through actual numbers rather than slogans, subscribe. One country, one machine, every week. Right. Chapter 1. What did you just buy? Start with the picture in your head because it's wrong. When people imagine the British economy, they picture something physical. Chimneys, shipyards, a car rolling off a line in Sunderland, maybe a farm. Now look at the composition. Services, banking, insurance, law, consulting, retail, hospitality, software, education, healthcare make up around 80% of British output. Manufacturing is roughly 9%. Construction, about 6%. Agriculture, which occupies most of the actual landmass, is around half of 1%. Read that again. The industry that covers 70% of the country's surface produces well under 1% of its income. So here's your first correction, and write it down because everything else depends on it. Britain is not an industrial economy with a big financial sector attached. Britain is a services economy with some factories left in it. That distinction matters enormously, and here's why. Factories are visible. They have gates, car parks, unions, and local newspapers that write about them. When one closes, everybody sees it. Services are invisible. A law firm in Leeds that doubles its billings doesn't cut a ribbon. Nobody photographs it, which means the British economy generates a very specific political problem. The parts that are shrinking are extremely visible, and the parts that are growing mostly aren't. That asymmetry has shaped 40 years of British politics, and we'll come back to it. Now the scale. By nominal output, Britain sits 5th or 6th in the world depending on the year and the exchange rate, sandwiched between countries with far larger populations. Output grew about 1% in 2024 and 1.3% in 2025. In the first quarter of 2026, growth came in at 0.6%, a decent quarter by recent standards, driven almost entirely by services. 0.6% in a quarter. That is what a good day looks like now. Hold that thought because we're about to find out why the ceiling is so low. This is the center of the whole story. Everything else is a consequence. Productivity means output per hour worked. It sounds like a technocrat's word, and it's actually the most important number in any economy because in the long run, it is the only thing that makes wages rise. Not negotiation, not policy, not goodwill. A country can only pay its workers more if each hour of work produces more. For roughly 160 years, British wages and British productivity moved together like two hands on the same clock. Productivity up, wages up. There were wars, depressions, oil shocks, and the relationship held through all of them. Then, in 2008, the clock stopped. Output per hour, which had been growing at around 2% a year, dropped to something close to 0 and stayed there. The Royal Statistical Society named it the statistic of the decade. Economists gave it a friendlier name, the productivity puzzle, which is possibly the most British thing in this entire video. A 15-year collapse in national income growth, and we called it a puzzle. Here is what makes it a puzzle rather than just bad luck. Every rich country slowed down after the financial crisis. Britain slowed down more. Between 2008 and 2017, the UK ranked 31st out of 35 OECD countries for growth in output per hour. And it did that while having one of the highest shares of tech-intensive employment in the developed world. Normally the thing that makes productivity rise fastest. So, a country full of the ingredients of growth not growing. The consequences show up in a place everyone recognizes. Adjusted for inflation, the typical British worker earned less in 2022 than the typical British worker earned in 2008. Real pay took roughly 15 years to get back to where it started. There is no comparable stretch in the modern record. You have to reach back past the Second World War, past the Great Depression, past the Victorians to find anything similar. Now, why? I want to be straight with you here because this is where a lot of videos start selling you a villain. The honest answer is that economists have not settled it. When the Center for Macroeconomics surveyed leading UK economists, they didn't converge on one cause. They spread across several. But four factors show up in almost every serious account. 1. Investment. British firms have persistently invested less in equipment, machinery, and buildings than firms in comparable economies. Since roughly 2012, the UK has actually experienced capital shallowing. The stock of tools and machinery per hour worked has been growing slower than the hours themselves. Britain has been adding workers faster than it adds things for them to work with. 2. Finance and North Sea oil. Some of the strong productivity growth before 2008 was flattered by a booming financial sector and a maturing oil field. Both faded. Part of the collapse is the disappearance of a bonus we'd been counting as normal. 3. Skills and management. Britain has a strong graduate population and a persistently thin layer of intermediate technical skills, the tier that in Germany or Switzerland runs the factory floor. Studies of management quality across firms tend to show a long British tail of poorly run small businesses. 4. Cities that don't work. In most rich countries, big cities are productivity engines. Density creates specialization. Specialization creates output. Outside London, British cities largely don't deliver that effect. Manchester and Birmingham are enormous by European standards and produce far less per worker than their size predicts. That fourth one is the thread. Pull it and the rest of the video comes apart in your hands. But before we pull it, sit with the investment point for a second because it's the one people find hardest to feel. Imagine two identical warehouses, one in Britain, one in the Netherlands, same products, same workers, same hours. The Dutch one has spent the last decade adding automated sorting, better software, more forklifts. The British one has spent the last decade hiring more people instead because labor was relatively cheap, borrowing wasn't, and demand never looks certain enough to justify a machine that takes 7 years to pay for itself. Year 1, they look identical on a spreadsheet. Year 10, one of them can pay its staff 40% more and the other cannot. Nobody in the British warehouse made a stupid decision. Every individual call was rational. The aggregate result was 15 years of flat wages. That's what capital shallowing actually looks like from inside a business. It isn't dramatic. It's 1,000 sensible deferrals and then a country that's poorer than it should be. But first, credit where it's genuinely due, because Britain owns something almost no other country does. Walk into the City of London. Roughly 38% of all foreign exchange turnover on planet Earth passes through the United Kingdom. Not 38% of Europe's, the world's. There are more US dollars traded in Britain than in the United States. Britain is also the largest offshore center for Chinese renminbi and the world's biggest center for cross-border bank lending, handling around 15% of the global total. More than 160 foreign banks keep an office there. The insurance market is the largest in Europe and third largest on Earth, and London holds something like 43% of the global market in specialty risk. The strange, difficult policies, satellites, oil rigs, cargo through contested water. Added up, and Britain runs the largest trade surplus in financial services of any country in the world. Bigger than the United States, bigger than Singapore, Switzerland, and Luxembourg put together. Count the lawyers, accountants, and consultants who orbit the same business, and the surplus reaches something like £119 billion. That is a genuinely extraordinary asset. And now I have to tell you why it doesn't solve the problem. Two reasons. The first is arithmetic. Financial services are colossally productive per worker, but they don't employ that many people relative to the size of the economy. A trading floor generating £1 billion might hold 200 people. A hospital serving the same city holds 5,000. Finance can lift the national average and touch almost nobody's payslip. The second reason is geography, and it's the one that actually matters. Those earnings land in a handful of postcodes. The city doesn't distribute its productivity outward because the thing that makes it work, the density of specialists, the courts, the accumulated legal precedent, the fact that everyone is walking distance from everyone else, is precisely the thing you cannot copy in Middlesbrough by opening a branch office. So Britain built a world-beating machine and then discovered the machine had a radius of about 4 miles. Which brings us to the part of the story that most explanations skip entirely. Here is a comparison that stops people cold. In 2019, output per worker in East Germany stood at about 80% of West Germany's level. 30 years after reunification, after the collapse of an entire economic system, after decades of transfers. Output per worker in southern Italy was about 78% of northern Italy's, the gap that has defined Italian politics since the country was assembled. Output per worker in the rest of the United Kingdom, compared with London and the Southeast, was about 71%. Britain's internal gap is wider than East versus West Germany, wider than North versus South Italy, and unlike those, it opened up without a wall, without a war, and without anybody deciding to do it. London alone produces close to a quarter of national output. London and the Southeast together account for around 2/5, and for most measures of productivity, they are the only regions above the national average, which means the average you read in the news describes almost nowhere. It's the midpoint between one very rich corner and everywhere else. Now, fairness demands a caveat, and it's an important one. The ONS itself warns against leaning too hard on regional GDP per head figures because people commute. Output gets counted where the office is, not where the worker sleeps. Someone living in Kent and working in Canary Wharf makes London look richer and Kent look poorer than either really is. Compare on productivity per hour and household disposable income instead, and the gap narrows. But it does not disappear. Across 28 separate measures of regional imbalance covering 30 advanced economies, the UK sits in the top quarter on 21 of them. The only countries that score as unequal are Slovakia and Ireland, both small enough to be single British regions. And this wasn't always true. Through the post-war decades, British regional gaps narrowed, reaching their tightest point around the late 1970s. The divergence is a product of the last 40-odd years. Rapid deindustrialization on one side, the rise of finance and business services on the other, landing in different places. So here is your second rule, and it explains more British politics than any manifesto ever written. The UK is not one economy. It is a small, extremely productive economy in the southeast, and a much larger, less productive economy everywhere else, sharing one currency, one interest rate, one tax code, and one parliament. A single interest rate has to serve a London housing market and a Teesside industrial estate simultaneously. It cannot. It is always slightly wrong for both and usually badly wrong for one. Now let's open the government's ledger because you're running this thing and the invoices have arrived. Public sector net debt sits at roughly 94% of GDP, about £2.9 trillion. That's the highest ratio since the early 1960s, and it works out at somewhere near £43,000 for every person in the country. Borrowing in the year to March 2026 came in at £132 billion, 4.3% of GDP. That was actually slightly better than forecast, and the lowest since before the pandemic, which tells you something about the standards we're grading on. But the line that should worry you isn't the debt, it's the interest. Debt servicing costs ran to somewhere around 110 billion pounds. In 2025 to 26, roughly 3.5% of everything the country produces. That money buys nothing. No hospital, no railway, no school. It is rent on decisions already made. And a chunk of it is unusually volatile because Britain funds itself partly through inflation-linked gilts. When inflation moves, the bill moves with it, which is why monthly debt interest figures swing by 5 billion pounds in either direction and confuse everybody reading the headlines. Meanwhile, inflation ran at 2.9% in July 2026, up from 2.6% in June, pushed by a 13% jump in the energy price cap. The Bank of England held its rate at 3.75% on the 30th of July, with 3 of 9 members voting to raise. The bank's own projection has inflation peaking near 3.2% late in 2026, which puts you, the person running this economy, in a genuine vice. Growth is weak, so you want lower rates. Inflation is above target and pushed by an energy shock the bank cannot influence, so you can't cut. And the OBR's arithmetic requires government revenue climbing from under 39% of GDP toward roughly 42%. A tax take at levels Britain hasn't sustained in modern peacetime. Raise taxes into weak growth and you risk the growth. Don't raise them and the debt path doesn't work. There is no clever third door. Anyone who tells you there is selling something. And underneath all of it sits demography. An aging population means pension and health commitments that rise automatically, regardless of who wins an election, unless somebody actively legislates to reduce them, which is roughly as popular as it sounds. There's one more feature of this ledger worth understanding because it changed the character of British politics almost overnight. Britain funds its deficit by selling gilts, government bonds, to investors who can decline to buy them. Every few weeks, the Debt Management Office holds an auction, and a room full of institutions decides what price it wants for lending the government money. That's it. That's the entire discipline mechanism. For most of the last 30 years, it operated quietly in the background. Then, in a matter of days in 2022, it stopped being background. Gilt yields moved sharply, pension funds using leverage strategies faced margin calls, the Bank of England intervened, and a fiscal plan was withdrawn. Whatever you think of the politics of that episode, it demonstrated something structural. The bond market's patience is a real constraint, not a rhetorical one, and it doesn't give notice. So the chancellor's actual job is narrower than it appears. Not run the economy. Keep a coalition of taxpayers, voters, and bondholders satisfied simultaneously. While the thing that used to make all three of them easier to satisfy, growth, isn't cooperating. 2 more things, and they're both stubbornly, unromantically physical. The first is electricity. In the most recent international comparisons, Britain had the highest industrial electricity prices of every International Energy Agency country reporting data, both including and excluding tax. Not high, highest. In 2023, the figure came in around 26 pence per kilowatt hour, roughly 46% above the IEA median and about 4 times the United States. Here's the detail that makes it a puzzle rather than a grievance. British industrial gas prices are below the IEA median. So the electricity problem is not simply imported fuel costs, it's the structure of the market, the network charges, and the way policy costs are loaded onto power rather than gas. The consequence is concrete. UK steelmakers have been paying roughly 40% more for electricity than French and German competitors, adding tens of millions to their annual bills. Business electricity is still around 70% above pre-2022 levels. Surveys show 4 in 10 firms cutting investment in response, which loops straight back into part 2. Firms that don't invest don't raise productivity. Workers whose productivity doesn't rise don't get raises. You cannot build an energy-intensive future, batteries, chips, data centers, AI, on the most expensive industrial power in the developed world. Governments know this. The 2026 Industrial Competitiveness Scheme is an attempt to discount it for thousands of manufacturers. Whether it's enough is a live question. The second constraint is land. Britain's planning system makes it exceptionally slow and expensive to build housing, laboratories, transport, grid connections, all of it. And that constraint hits productivity through a route people rarely trace. If a worker in Sunderland could double their output by moving to Oxford, but a home in Oxford costs a multiple of what they can afford, that productivity gain never happens. The economy loses it permanently. Housing costs aren't just a cost of living issue. They're a productivity issue wearing a disguise. An overheating southern housing market stops people moving to where they'd be most useful, which is one of the mechanisms researchers point to when explaining why British cities underperform their size. Same for infrastructure. Manchester and Birmingham have populations that should generate serious agglomeration effects. They don't, and one consistent explanation is that their local transport networks don't actually connect a labor market at metropolitan scale. A city where you can only reach a fraction of the jobs in a reasonable commute isn't functioning as one city. It's functioning as several small towns that happen to share a name. Right? You've seen the books. Give me the verdict. Yes. And I mean a real yes, not a hedge. Nothing in this video is a law of physics. Britain has world-class universities, deep capital markets, the English language, a legal system that half the planet's contracts are written under, and a services sector that genuinely leads the world. These are not the assets of a country that has to decline. Growth of 2% a year sustained would transform every number we've discussed inside a decade. But notice what that requires, because it isn't what the arguments are usually about. Every path back to 2% runs through the same three things: firms investing more, cities that function at their actual size, and enough energy and enough buildings at prices that don't strangle the projects before they start. Everything else, the tax debates, the spending debates, the Brexit debate, where the official forecaster assumes a long-run productivity cost that other economists dispute in both directions, is an argument about how to divide the pie, arriving at a moment when the pie stopped growing. That's the real discovery here. Britain didn't get poorer. Britain stopped getting richer, and then spent 15 years arguing about the distribution of an income that was no longer rising. Every fight since 2008, over the NHS, over pensions, over wages, over immigration, over the union itself, is that argument in a different costume. So look again at that gap from the opening. £37,000 instead of 41. £4,000 a year per person that Britain didn't produce and therefore cannot spend, cannot tax, and cannot argue over. It was never really a hole in the accounts. It was a hole in the arithmetic of the future, the compounding that didn't happen, the raises that weren't affordable, the investment that never got made because there was no return to justify it. Debt you can refinance, taxes you can change, a government you can vote out in an afternoon. Compounding you cannot get back. It only ever runs forwards. You weren't handed a broken economy. You were handed a stalled one. And the difference between those two words is the whole of British politics for the next 20 years.